Hello and welcome. Today we're going to unpack one of the most important sections of the Federal Acquisition Regulation for any firm doing business with the U.S. government, FAR Part 9, Contractor Qualifications. Over the next slides, we will cover all 7 subparts, from how the government decides whether a bidder is responsible through debarment and suspension, conflicts of interest, and teaming arrangements. Whether you're pursuing your first federal contract or managing a mature portfolio, the rules in Part 9 determine who can win and who can't. By the end of this briefing, you'll have a clear mental model of how these rules fit together and where the common traps lie. I'm your host from Neybor Consulting, and I'll be walking you through each section with examples and practical guidance. Here's our roadmap for the next 30 to 45 minutes. We'll start by framing why FAR Part 9 matters, who it applies to, and why it exists. Then we'll walk through the structure and cover each of the 7 subparts in order. Along the way, I'll show you real-world examples, the decision processes contracting officers actually use, and the most common pitfalls we see at Neybor. We'll close with a practical compliance checklist and details on how you can work with us to apply these rules in your own procurement pipeline. Feel free to hold questions until the end, or raise them as we go if something's unclear. Before we get into the mechanics, let's set the stakes. Federal prime contract spend runs above $750 billion a year across the government. Every single one of those dollars flows through the rules set in FAR Part 9. The guiding principle is on the left. The government is directed by regulation to award contracts only to responsible prospective contractors. That sounds simple, but it generates 3 practical consequences. First, Part 9 is the gatekeeper. If the contracting officer cannot make an affirmative determination that you are responsible, you do not get the award, even if your price is low. Second, these rules create enterprise risk. A single debarment can sideline your firm for up to 3 years across every federal agency simultaneously. Third, the hardest issues, conflicts of interest, teaming arrangements, product qualifications, all have to be addressed during pursuit, not after award. Waiting is how deals unravel. Keep those 3 ideas in mind as we go. At a glance, Part 9 is organized into 7 subparts, shown here radiating out from the central hub. The first 3, 9.1, 9.2, and 9.3, address affirmative qualifications. Is this contractor responsible? Are their products on the approved list? And does their first production article meet spec? Subpart 9.4 flips the script to negative qualifications, debarment, and suspension, the reasons a contractor gets excluded. Subpart 9.5 handles organizational conflicts of interest. Subpart 9.6 governs how multiple firms team up to pursue a contract. And 9.7, defense production pools is a narrow but occasionally important authority. The rest of the briefing takes each subpart in turn, so hold this mental map in mind as we go deeper. Subpart 9.1 is the heart of Part 9, and it sets up one of the most important ideas in federal procurement, the threshold test of responsibility. Before a single dollar changes hands, the contracting officer must make an affirmative written determination that the bidder is a responsible prospective contractor. Think about what that means in practice. First, this decision sits with the contracting officer, the CO. Not the program office, not the requiring activity, and definitely not the bidder. Second, responsibility is not presumed automatically. The CO has to find that the information in front of them is sufficient to support that conclusion. Third, and this is where many bidders get surprised, if the information is unclear or missing, the CO is actually required to find the bidder non-responsible. The burden of persuasion is on you. Finally, every determination gets documented in the contract file. For small businesses, a non-responsibility finding triggers a separate certificate of competency review by the Small Business Administration. But more on that in a moment. Here are the 7 general standards from FAR 9.104-1. Every prospective contractor has to affirmatively meet each one. 1. Adequate financial resources, or the demonstrated ability to obtain them. 2. The ability to comply with the delivery or performance schedule, given your other commercial commitments. 3. A satisfactory performance record. Past performance on similar work. 4. A satisfactory record of integrity and business ethics, which ties directly into the debarment and suspension rules. 5. The necessary organization, experience, accounting, and operational controls and technical skills. 6. The necessary production, construction, and technical equipment and facilities. And 7, otherwise qualified and eligible, a catch-all for any other statutory or regulatory bar. Here's the key. These are not a weighted scorecard. A failure on any single standard is enough to produce a non-responsibility determination. You pass all 7, you're eligible for award. You fail one, you just know you're out. How does the contracting officer actually make the responsibility determination? The workflow at the top shows the sequence. The offer comes in, the CO checks SAM.gov and FAPS, reviews past performance through CPARS, commissions a pre-award survey if needed, and issues a written determination. The 4 cards along the bottom walk through the primary information sources. SAM.gov is the central registration and exclusions database. Every federal contractor must be registered there, and the exclusions list flags anyone who's been debarred or suspended. FAPS, the Federal Awardee Performance and Integrity Information System, is the integrity file. It captures terminations for default, administrative agreements, and non-responsibility determinations. CPARS holds past performance evaluations written by the government itself after each prior contract. This is often the most influential evidence. And when the paper record is ambiguous, the CO can commission a pre-award survey, which is a structured review of the contractor's capacity, often performed by DCMA or an agency equivalent. A strong pursuit strategy anticipates each of these sources and gets ahead of any adverse entries before they matter. Subpart 9.2 deals with qualification requirements, formal pre-approval lists that the government maintains for certain high-risk or high-complexity items. There are 3 flavors. The Qualified Products List, or QPL, covers specific product models that have been lab tested and verified against a specification. The Qualified Bidders List, or QBL, is about the firms themselves. It captures bidders whose capability to perform has already been examined. The Qualified Manufacturers List, or QML, looks at the production process. The idea is that if you approve the way a manufacturer builds, you don't need to retest every finished unit. Why bother with these lists? 2 reasons. The cost and time of testing each candidate on every individual contract would be enormous, and for some items, the consequences of failure are unacceptable. The example at the bottom makes that concrete: submarine valve fittings. The Navy isn't going to retest every valve on every solicitation. It's going to restrict competition to firms on the QPL. The practical point for contractors: if you're pursuing work in a field where a QPL, QBL, or QML exists, getting on the list is often a separate, expensive process that has to be planned well before any solicitation drops. Subpart 9.3 covers first article testing, often abbreviated FAT. The idea is simple. Before a contractor ramps up to full production, they manufacture 1 or more pre-production samples, the first articles, and submit them to the government for testing against the spec. Only after that sample is approved does full-scale production begin. Why bother? For complex, critical, or safety-sensitive items, the cost of discovering a specification failure after you've built 10,000 units is orders of magnitude higher than the cost of testing 1 unit up front. The green card on the right shows when FAT is appropriate. Complex items, new contractors, or new processes, reactivated product lines. The red card shows when it's typically waived. Commercial off-the-shelf products, items already on a QPL, and R&D work where testing is built into performance. The bottom of the slide walks through the flow: award, produce, submit, evaluate, approval, or fail, then full production. If the first article fails, the contractor generally has to perform corrective action and resubmit, and the cost of that rework usually falls on the contractor unless the spec itself is shown to be defective. Subpart 9.4 is where things get serious. There are 3 related mechanisms the government uses to exclude non-responsible contractors from the federal market. First, debarment, a long-term exclusion, typically up to 3 years, imposed after the government has proven a cause. Second, suspension, a faster, temporary exclusion usually capped at 12 to 18 months, which can be imposed on adequate evidence while an investigation continues. Third, ineligibility. This is when a specific statute or executive order bars a contractor from a category of work. For example, under Davis-Bacon wage violations or certain EEO compliance findings. Critically, all 3 have the same practical effect shown in the cream box. The excluded party can't receive new federal contracts, most subcontracts above $35,000, grants, or other federal assistance. And it applies across the entire executive branch, not just the agency that took the action. One action, whole government. The two bottom boxes underline the scale. There are tens of thousands of active exclusion records in SAM at any given time, and the government-wide reach means that losing one agency's trust means losing access to all of them. This slide lines up the two most common exclusion tools side by side. Debarment, shown in the navy column on the left, is the verdict. It requires a cause proven by preponderance of the evidence, and it typically runs up to 3 years, although it can be extended. The triggers are serious: a criminal conviction, a civil judgment, or any other cause of a character serious enough to affect present responsibility. Suspension, the red column on the right, is the fire alarm. It's designed for immediate action on adequate evidence, often just an indictment or the filing of a civil complaint. It's meant to protect the government's interests while an investigation continues, so the initial period is capped at 12 months, extendable to 18. The two tools have different standards: preponderance of evidence for debarment, adequate evidence for suspension, but the practical effect on the contractor is identical: no new federal contracts. If you remember nothing else from this slide, remember the bottom line. Suspension is the alarm, debarment is the verdict. Either one takes you off the playing field. Let's look at what actually causes debarment. The left column groups the causes into 5 buckets. First, criminal conduct, fraud, antitrust violations, embezzlement, forgery, bribery, tax evasion. Second, civil judgments, especially under the False Claims Act, which is the single most active debarment driver in federal contracting. Third, performance failures, not one bad contract, but willful or repeated failures. Fourth, specific regulatory misconduct like drug-free workplace violations or knowingly filing false certifications. And fifth, a catch-all, any cause so serious it affects present responsibility. The illustrative case on the right shows how this actually plays out. Take a mid-sized IT services firm with $40 million a year in federal business. They're investigated for inflating senior engineer hours on time and materials invoices. DOJ files a Civil False Claims Act complaint. The agency suspension and debarment official, or the SDO, issues a suspension on adequate evidence. Immediately, they lose eligibility for all new federal work across every agency. Pending proposals worth $18 million get set aside. After the case settles, the firm negotiates a 3-year debarment and administrative agreement. The cause was a single pattern of billing fraud. The consequence is easily $120 million in lost lifetime revenue. That's why integrity controls aren't optional. This chart shows where exclusion actions actually come from. The data here is illustrative, drawn from patterns in federal enforcement reporting, as actual figures vary year to year, but the shape of the picture is consistent. Procurement fraud is the dominant category, accounting for roughly a third of actions. False Claims Act violations are the second biggest slice, and in practice, FCA settlements are the most common pipeline from investigation to debarment. Pure performance issues, surprisingly, are the smallest slice. The system was built to catch integrity failures, not performance failures. Performance problems tend to produce terminations for default, which are reported in FAPEUS and influence future responsibility determinations, but by themselves rarely lead to debarment. Two practical consequences shown on the right. First, an effective compliance program focuses on the integrity vectors: invoicing, certifications, subcontractor representations. Second, you must screen every tier of your team. An excluded subcontractor above $35,000 poisons the award for the entire team, so SAM checks belong in your proposal workflow and your subcontract award workflow, not just at registration. Subpart 9.5 governs organizational conflicts of interest, OCIs, and it is probably the most litigated corner of Part 9. The definition on the left is long but worth reading slowly. An OCI is a situation where a contractor's other activities or relationships may either impair their objective performance, give them an unfair competitive advantage, or prevent them from giving impartial assistance to the government. 3 conditions, any one of which can create an OCI. The policy goals shown in the top right are about protecting the integrity of procurement, no conflicted advisors, no unfair advantages, and no appearance of favoritism. The contracting officer's duties in the bottom right boil down to 4 verbs: identify, evaluate, avoid, neutralize, or mitigate, and document. Crucially, OCI analysis is supposed to happen as early as possible in acquisition planning, not the night before award. If you spot a potential OCI in a proposal you're working on, the right move is to disclose it proactively and propose your own mitigation plan. Hiding it almost never works, and pretending it isn't there is the fastest way to lose an otherwise winning bid. This is the framework every OCI analysis uses. 3 categories originally articulated in the GAO's Aetna Government Health Plans decision, now embedded in how the FR Subpart 9.5 is interpreted. The first type is unequal access to information. The contractor has access to non-public government information that wouldn't be available to competitors on a future solicitation. The classic example is performing a market research study for the government and then bidding on the work that study described. The second type is biased ground rules. Here, the contractor actually shaped the specifications, evaluation criteria, or requirements of a procurement. Writing the statement of work and then bidding on it is the textbook case. The third type is impaired objectivity. The contractor's ability to give unbiased advice to the government is compromised by other business relationships. A classic example is being asked to evaluate the performance of a product made by your parent company, or to review a contract held by a subsidiary. When you analyze a potential OCI, start by asking which of these 3 buckets it falls into. The answer drives the mitigation strategy, which is the next slide. Once you've classified the OCI, the FAR tells the contracting officer to work through a preference hierarchy shown on the left: avoid, neutralize, mitigate. Avoid is the strongest, disqualify the conflicted offer, or have the contractor decline. That's clean and defensible. Neutralize sits in the middle, structural changes that remove the conflict, like divesting a conflicted business line or restructuring a team to exclude conflicted personnel. Mitigate is the weakest response. Risk reduction measures like firewalls, non-disclosure agreements, and formal mitigation plans. The tools on the right are the ones you'll most often see in a mitigation plan. Firewalls physically separate conflicted staff from information they shouldn't see. NDAs extend confidentiality obligations. Divestiture is the nuclear option, but sometimes the only option. Recusal means declining to bid on the specific follow-on work that creates the conflict. And proactive disclosure plus a written mitigation plan is almost always the smart move. It demonstrates integrity and gives the CO a workable path forward. The bottom line, in gold, the earlier you surface the conflict, the more flexibility you have in how you solve it. OCIs discovered after award are 10 times harder to fix than OCIs flagged during solicitation. Let's walk through a worked example, the kind of scenario that actually comes up in proposal work. On the left, the facts. Acme Advisors holds a $5 million advisory contract helping an agency draft the technical specifications for a new logistics IT system. 6 months later, the agency issues a $200 million competitive solicitation to build that same system. Acme has a services arm that wants to bid as the prime. Simple question, OCI or not? The answer is on the right. Yes, 2 OCIs are in play. First, biased ground rules. Acme literally wrote the specifications that now form the basis of the competition. That's the textbook case. Second, unequal access. Acme had visibility into non-public cost data and internal agency thinking that no competitor could see. So what is the contracting officer likely to do? In most cases, avoid to exclude Acme from the bid. Even a robust firewall can't fix biased ground rules because the bias is already baked into the solicitation text itself. Firewalls mitigate unequal access, but they can't undo spec writing. The lesson for Acme? If they wanted a shot at the build contract, they needed to structure the advisory engagement differently from day one, perhaps by scope limiting the spec's work, or by contractually agreeing up front that they wouldn't compete on follow-on implementation. Subpart 9.6 addresses contractor team arrangements. The opening policy statement is important. The federal government explicitly recognizes team arrangements as a legitimate way for companies to pursue federal work. There are 2 basic structures, illustrated here. On the left is the joint venture. Two or more firms form a new legal entity that holds the contract, and both partners share responsibility for performance. Joint ventures are common when the scale of the work, the bonding requirements, or the specialized capability mix exceeds what any single firm can deliver. On the right is the prime subcontractor team. One firm holds the contract and is the sole interface with the government. The primary contractor subcontracts portions of the work to teammates. This is by far the more common structure, especially on services work. Three key policies at the bottom. First, the government recognizes teams early. Disclose the arrangement in your proposal where possible. Second, recognition is not endorsement. The government does not sponsor or pick winners among teaming arrangements. Third, each team member retains individual Part 9 responsibilities, SAM registration, OCI screening, and so on. A clean prime doesn't inherit clean status for a dirty sub. Let's do a side-by-side on the two main team structures, the decision that most pursuit teams have to make. In the left column, joint venture. Legally, you create a new entity. The two partners share liability jointly and severally, and the JV itself holds the contract. This is the right choice when you need to combine bonding capacity, when you're combining complementary small business set-aside eligibilities, or when the scale of the effort exceeds any single firm. But you're also marrying your partner. Their problems become your problems. In the right column, the prime sub-team. Each firm stays independent, only the prime signs the contract, and the prime carries the full weight of performance responsibility. This is the structure you want when you need a specialist for a specific capability, but don't want structural integration. Past performance tracking differs in an important way. The prime gets a CPARS rating for the whole contract, and subs build their own reputation separately. Risk is different too. In a JV, both partners answer for failures. In a prime sub, the prime eats the failure and has to chase the sub contractually. There's no universally right choice. It's a function of the deal economics, the capability mix, and the strategic relationship between the firms. Subpart 9.7 is the least used corner of FAR Part 9, but it's worth knowing it exists. It authorizes defense production pools and research and development pools. These are groups of concerns, firms, that formally band together under either the Small Business Act, Section 7, or the Defense Production Act of 1950 to jointly perform federal contracts. The key mechanism shown in point 3 is that the pool itself is treated as a single contracting party. Rather than the government signing contracts with 10 small manufacturers, it signs one contract with the pool, and the pool allocates the work internally among members. In practice, pools are narrow and industry-specific, historically used in defense manufacturing like metals, munitions, and aerospace components. The Small Business Administration or the relevant Defense Production Act authority must issue an eligibility certificate before a pool can receive an award. For most of the teaming needs contractors face today, the mechanisms in Subpart 9.6, joint ventures, and prime sub arrangements are a better fit. Pools survive in niche defense applications, but you're unlikely to encounter them in a typical services or IT pursuit. If you take nothing else away, take this checklist. Every row on the left reflects a Part 9 requirement we've covered. Confirm your SAM.gov registration is active and unexcluded. Review FAPIS entries so you aren't surprised by something in your own file. Document financial capacity. Check QPL, QBL, or QML eligibility if the item requires it. Screen both primes and subs for exclusions. Identify and disclose any OCI. Document any teaming arrangement before you submit, and always maintain records that support the responsibility determination. Beyond the mechanics, 3 enduring principles on the right. 1. Responsibility is earned, not assumed. If you don't put the evidence in front of the contracting officer, you don't win. 2. Integrity drives eligibility. The biggest exclusion risks are ethical and billing problems, not delivery problems. 3. Surface conflicts early. An OCI disclosed in the proposal can often be mitigated. The same OCI discovered at award is usually fatal. Here are the 6 pitfalls we see most often in our client work. First, expired SAM registration. SAM requires annual re-registration, and the renewal cycle never coincides with your pursuit calendar. A proposal submitted with a lapsed registration is ineligible. Full stop. Second, ignoring adverse FAPIS entries. Contractors almost never read their own FAPIS file until an agency flags something, and by then it's too late. Pull yours every quarter. Third, Late OCI disclosure. If you identify a conflict during pursuit, disclose it in the proposal, not at negotiation. Early disclosure gives the CO the option to accept a mitigation plan. Late disclosure forces the CO toward avoidance, which almost always means exclusion. Fourth, unchecked subcontractors. Primes do rigorous SAM checks on themselves and forget to screen second-tier subs, but the exclusion rule applies across the team. Fifth, assuming past responsibility carries over. Every new procurement is its own affirmative determination. A CO doesn't get to rely on the determination made by a peer on a different contract. Sixth, skipping the teaming agreement. Handshake partnerships break the moment the award is announced and the economics become real. Always paper the arrangement before proposal submission. So, where does Neybor Consulting fit in? Our practice is built around the Part 9 lifecycle, the end-to-end set of activities that separate firms who win federal work from firms who bid federal work. 5 service lines on the right. First, our responsibility readiness review, a preemptive audit of what a contracting officer would actually see when they open your SAM profile, your FAPEIS file, your CPARS history, and your financial evidence. We find the problems before the CO does. Second, OCI risk mapping. We classify your exposures into the 3 categories and build mitigation plans that are drafted to be CO ready, not just internally defensible. Third, debarment defense. If you're facing a show cause letter or investigation, we build the response strategy, the factor-based arguments, and the path to an administrative agreement that keeps you in the market. Fourth, teaming strategy, from joint venture formation to prime sub-structuring and scope of work drafting. And fifth, compliance training for your executives and pursuit teams. Every service is customized to your portfolio. We don't do generic playbooks. Thank you for spending this time with us on FAR Part 9. If any part of what we covered today, the 7 responsibility standards, the debarment framework, OCI mitigation, teaming strategy, raised a question about your own portfolio, we'd love to help. Visit Neybor Consulting. Come and book a free 30-minute consultation. On that call, we'll walk through your current SAM and FAPEIS posture, identify the 2 or 3 highest risk issues in your active pursuits, and map a concrete next step. You don't need to have a crisis to call. The best Part 9 work is preemptive, quiet, and done months before anyone is watching. Once again, Neybor Consulting. I look forward to speaking with you soon.